We're going to talk about mortgages. I am sure you have heard, oh my goodness, I need to buy a home. I need to understand how my taxes work because from what I understand, owning a home will save me money on my taxes. That's true sometimes. Please do not fall into the category of people that do not read their mortgage statements, do not look at their mortgage agreements or documents, and decide somehow that this mortgage and owning this home is going to save you money. Here's the scoop. There are several kinds of loans. The bank wants you to invest more in your house than they have. I'll say that again. The bank or the lender wants you to invest more in your home than they have. So when they're asking for a down payment, and usually it's 20%, it's your investment in that property. They actually now like 30% on a residential property. So if you're going out and buying a home, they want a 30% down payment. Here's why. They are figuring that the economy will not fall so much that their position of a lender in your house is going to be jeopardized. So if you buy a house for $60,000 and you have to put 30% down, so 30% of $60,000, let's see, 10% would be 6, so 180,000. If you invest $180,000 in a $600,000 home, they're guessing that your home is not going to drop below $420,000 if they have to take it back. We're going to do the math again. You find a beautiful 3-bedroom, 2.5 bath on a nice piece of land with a nice backyard and a 2-car garage. And the house is listed and you buy it for $600,000. So you came up with $180,000, which is 30%. So the lender only had to give you $420,000. They look around your neighborhood, they get an appraisal, and they say, okay, in the worst of times, would this house drop below $420,000? And the answer, if they're going to lend you the money, is no. They don't believe that it will drop from the $600,000 you paid for it down to $420,000 or below. So they say, okay, we'll lend these people some money. Well, I just told you that's a pretty hefty down payment. $180,000 is a pretty hefty down payment. Now, on that house, if you get a great interest rate of 3.5%, and you actually get a loan that is interest only, you're going to say, wow, this interest payment is way less than the rent I was paying on my 3-bedroom condo. This is really a good deal. And so you say, well, I'd rather own my home. So you have a payment that's interest only. Well, let's say, what if your payment has to have principal in it? Well, the principal could be anywhere from $600 to $2,000 added on to that interest monthly, because they want you not only to put the $180,000 in, but they want you to pay down that $420,000 every month. They want to see that gap getting bigger and bigger and bigger between what you paid for your house and what you owe on your house. Those are the principles behind buying a house for the lender. Now, some of you in your payment would have your property tax divided by 12. And remember, in the state of California, your property tax is about 1.1% of the selling price of the house. So $600,000 house, the taxes would be $6,000 to $6,500 a year. And then they would divide that by 12 and put it in your payment. So let's say you have a payment of $2,200 and then they take your taxes and they add in $500 a month for your property taxes. So then your payment's $2,700. And then they say, oh, well, your insurance is $1,200. So we're adding in another $100. So your payment is $2,800 or perhaps higher than that. But it includes all those things. And you go, okay, that's great. I don't have to remember to pay my property tax and insurance. My lender will do that. Yes, they will. And just remember that they will always do that. And if you start not paying your mortgage, this is where they get into trouble, because now who's paying the property tax? Who's paying the insurance on the house? And they're not covered anymore. So that's why during that horrible housing crash, people were reneging on the promise they made to pay these loans. And then the bank had to take these homes back. The counties weren't getting their property tax. The insurers weren't getting their insurance premiums. And the general public said, oh, the bank screwed me over, and so what do I care? They lied to me about my mortgage. Well, you know what? It really is on you if you didn't read the fine print of your agreement and if you didn't honor your mortgage. So I want to wipe that off the slate right now. It is not okay for you not to honor the piece of paper that you signed for your house or your condo. If you signed the agreement, that means you owe the money. And if you can't pay it, then you have to do the right thing to get out of it. You have to sell your property, but you don't put it on anybody else. All right, so there's a little moral dilemma there when you get into trouble with your house. But the other part of buying a house or a property is that it will help you on your taxes. You know what, everybody? It will help you on your taxes only if all of your deductions for your house is equal to or more, and I say more, than your standard deduction. So let's say you bought a house and you got a great interest rate, and your interest is $1,000 a month, and you're going, wow, I own a home, my property tax is this, my interest rate is this, but I'm a family of 5. And your family of 5 gets deduction, what is it, $21,000 there? I don't know what the standard deduction is for 2016. I'd have to look it up. But let's say your standard deduction for your family of 5 is well over $20,000, but your interest, your property tax, and those other deductions don't equal that. Well, that house is not going to help you with your taxes. Your standard deduction will be higher. And you say, I don't even understand what you're talking about, Robin. Well, what we're going to do in another segment is we're going to look at what a Schedule A is versus what the standard deduction is. And a Schedule A is what most people are trying to achieve. That means that you have enough in your home and you're paying enough money to property taxes and interest that you can actually open up a Schedule A. And a Schedule A has charitable donations on it, the ability to deduct medical. It opens up a whole nother segment of tax deductions for you. And what people push and lenders push is, if you own a home, this will be a tax deduction. If and only if those expenses that are deductible on your home are higher than a standard deduction you get to take for your family of 5. So we'll go into that in more depth, but I just want to break 2 myths here. That owning a home is always better for you tax-wise. That's not always true. And that if you didn't read your agreement and it ends up being kind of a bad thing for you, that you can walk away and it's the bank's fault. Those 2 things are not true about home ownership. And now home ownership has gotten even harder because of people who walked away from their houses. And let's not forget, it will all wreck your credit score. And we'll talk about credit scores in another segment, and credit scores, and kind of sometimes they're pretty bogus and that they're not fair, but definitely if you walk away from a mortgage and it goes on your credit score as a foreclosure or a default, that's actually on you. Unless someone out and out lied to you, you need to honor those agreements with mortgages. So I think what we did was we maybe busted the myth about renting being a bad thing, and that a mortgage is always a good thing. It has to be, unfortunately, case by case, and you have to look at it. And I have a friend who said to me, I kind of made up some draft tax returns for a couple of years to see if, when I put in the expenses of the purchase I wanted to make, if they really helped me tax-wise. And she discovered, well, no, they really didn't. They didn't really help me at all. And that's a smart way to do it. Do your tax calculation. Do a mock tax return. We're going to learn those things. We're going to learn how to do those things. And we're going to learn how to understand what we're getting ourselves into. And I'm happy to be one of the people that will help you with that and guide you toward a good decision.